Most people don't lose money in property because they picked the wrong tile colour or they slightly overpaid on the kitchen. Most people who lose money in property lose it because they've skipped deal analysis or due diligence. The most frustrating thing is that property investment inherently isn't that intellectually taxing. The framework isn't a secret, but some people rush the process because they've seen a deal they particularly like. Today, I'm going to walk you through the exact framework that we use in my business, Frater Property Partners, so we can fully analyse deals and we can pull the trigger as and when we need to. This includes 5 steps in sequence that filters out a different level of risk each time. If you missed just one section, you've not done enough due diligence, so we'll put this together so we can walk through it and then you can go out and do it on your own deals. If you're new here, welcome. My name's James. I'm the co-founder and managing director of a property investment consultancy called Frater Property Partners. I've personally helped hundreds of investors purchase tens of millions of pounds worth of property all across the UK, but this channel is all about your education. So let's get into it and look at step 1, the macro filter. Before you even look at a property, you need to make sure that you're confident on the location or the areas in which you want to invest. We're not just buying a property because experienced investors don't just buy houses, they buy into the local economy. This distinction matters a lot more than what a lot of people actually believe, because ultimately the property doesn't grow in value, the area does. Essentially, you're entirely dependent on the demand and what's going on in the local area. So yes, you can buy a property and do a project and add value to that property, but once it's there, it's going to depend on what's going on in the local area. So the question isn't whether it's a nice street, the question is what is going on in the wider economy of that local area. We need to make sure that the underlying fundamentals are still going to be there in 5 to 10 years time, and we're making sure that it's going to be an area that people continue to want to live in. This means several things that we're looking at when we first target a specific area. First, you start with a diverse and growing job market. It doesn't really matter which industries are there, but it does matter that this is diverse and it's got a lot of opportunity for jobs. Ultimately, you don't just want to buy into an area where there's only one company as the employer there, because ultimately if something goes wrong with that company or something changes, they decide to move, then your investment's at risk. So you need to be looking to make sure there's multiple industries and lots of businesses already based there, but hopefully even more that are moving to the area. So for example, Manchester has a lot of job opportunities already, but we're seeing more and more businesses move to the area and move to the city, which creates more jobs and in turn improves demand because people are moving to the area for those job opportunities. Once we've done this, we then look for infrastructure and institutional investment. This is ultimately more things that improve the demand for properties in a certain area. For example, if there's improved transport links to an area, people might work in that area and live a little bit further out, which means again property prices are going to increase in these other areas. Again, if there's massive spending going into an area, multi-millions if not billions of pounds worth of investment going into an area, improving it and improving the infrastructure, you can be confident on the long-term prospects of that location. To be honest, it doesn't really matter where the money's coming from, but it needs to be significant so you can be confident on the long-term prospects of this area. These things include things like HS2 investments and multi-city regeneration projects. They basically change commuter patterns, attract businesses, and because they attract businesses, they then get more people moving to the area for these jobs. The thing you need to be aware of though is we're not just targeting major cities, we need to make sure the locations we're investing are still affordable for the local people. If normal people can afford normal homes, the demand will stay high and we can see long-term growth moving forward. This is why right now we're not investing in the southeast and London, because they've hit an affordability ceiling, and even though they have great fundamentals, people aren't buying the homes in those areas, so prices aren't growing as much as other areas in the country. The final thing you need to look at in the macro environment is the supply versus demand in that area. Obviously all of the things prior to this are going to impact demand in the long term, but we want to make sure that there's a demand there right now as well. This can be where some beginner investors often get caught out because they might see long-term demand, but if there's 1,000 properties being delivered in a very small location, a small town, then there might not be those long-term prospects. Obviously 1,000 or even a few thousand homes in a major city like Leeds won't change things because demand is so high and we're so far behind supply, but if there's that many properties coming into a significantly smaller town, then it's something that might not stack up in the long run. Basically, you need to check the planning and make sure that there's not too many properties being delivered. Ultimately, if supply outweighs demand, then you're not going to see the rental growth or the capital appreciation in the long term. Having said that, that's usually only in smaller locations, so commuter towns and places like that, rather than the major cities. So once this location passes the first macro filter, we then need to make sure that we're looking at specific locations and making sure that the property is priced correctly. We call this step the comparative market analysis. With this one, we're looking at what the property that you're considering is actually worth. Remember, we're not just looking at what the asking price is, we're looking at what we believe is the true value of that property. This sounds obvious, but it's surprising how many investors don't look into this before they commit to a specific deal. Depending on who's put the property on the market, the asking price is often just a marketing number. It's what the vendor would like to get for that property. It doesn't always reflect what the actual value of that property is. This is why anytime you're looking at a property deal, you need to be looking at comparable evidence in the local area. Yes, look at what properties are on the market in the current area on things like Rightmove, but the true valuation of these properties often comes from sold prices. What you can do here is use things like the land registry and Rightmove sold prices to get a genuine understanding of what the value of the property is worth. You need 5 to 7 properties within a quarter or half a mile of that property with a similar square foot and a similar finish. Don't look too far back in terms of timelines because property prices are likely to have moved on within the last 2 to 3 years. This is basically your baseline, and the tighter you are with your requirements, the more accurate you're going to get with the true valuation of the property you're considering. If you're looking at a 2-bed terraced house, a similar 2-bed terrace that sold 6 months ago on a street 2 streets away is a genuine comparable property that you can look at. A detached 4-bed sold 3 streets away is not something to consider because it's so different and the square foot is likely to be worlds apart. Basically, the 4-bed tells you almost nothing. From there, you work in the square foot of the property. Price per square foot is a brilliant way of actually considering what you're paying for the property. It allows you to compare properties that are slightly different to yours, and you can make sure that you're paying somewhere in the right region of what they paid for previously. The reason I say this is if we go back to the 2-bed terrace house scenario, we need to make sure that they're similar square foot and they've been sold for similar prices, because you could get a 2-bed terrace house that had a massive extension and the square foot is 300 square foot different to the one that you're considering. Once you've done this and you feel that the property is priced correctly, you need to make sure that properties in the local area are selling. Even if you're planning on holding this for the next 5 to 10 years, you want to make sure that properties sell in this local area. If they sit on Rightmove for 6 months, if you ever need to exit or get your money back at any point, you could be stuck with a property that people don't want to buy. Again, this is just an honest signal of how buoyant that local market is and what the local demand is for that area. If the properties are sitting on the market for 6 to 9 months, then it's actually a good sign that the demand for that area probably isn't that strong, or that the price is a little bit too aspirational. Either way, it helps you, either to make sure that you're getting into the right property, or it gives you leverage to get a better deal. Next, step 3, the finance test. Once you're confident on the macro area and the property that you're looking at, you need to make sure that all of the numbers stack up. Regardless of how much time you spent on it or how much you like the property, if the numbers don't stack up, you need to walk away. Having spent a lot of time on a deal doesn't mean that you shouldn't be able to walk away. It's better to walk away from a deal after spending several hours doing your research or attending a few viewings than buying a property that doesn't work for the next 10 to 15 years. The first thing you need to do is the obvious and look at your cash flow. Obviously check your gross yield that gives you high level figures, but the true returns are your net yield and your rental profit. This is where a lot of deals look positive initially and then actually fall apart under any scrutiny. You need to subtract your management fees, which are going to be 10 to 12% of your rental income every month if you're a hands-off investor in getting the property managed. Then you need to look at things like your mortgage costs, a 5% maintenance budget, and maybe even a 5% void budget. Chuck in any service charges or anything else that you need to be aware of, and then that's the money that you're going to get every single month. This is very, very basic and very straightforward, but you need to be able to do this before you commit to a deal, otherwise you're just wasting your own time. If you don't have a calculator that you can plug numbers in, I will put one in the description so you can download that, but please make a copy so you can then edit that and play around with the numbers for each deal that you see moving forward. Once you've done this and you can see that it stacks up, you then need to stress test. This is where you play around with things like the mortgage rates to make sure that the deal still stacks up in 2 to 5 years time, even if we're under different rates for your mortgage. Remember, a typical investment in property might be 10, 15, 20 years down the line, and rates are going to change at least a couple of times during that time frame. You don't want to have to be in a position where you're just keeping your fingers crossed that when you come to remortgage that rates are going to be lower. You need to make sure that even if they are higher, which wouldn't be ideal, that the property still stacks up in the long term. If your deal doesn't work, if rates increase by 0.5%, then the deal doesn't really work. I'm sure you're aware, but this is what caught out a lot of both investors and home buyers who got used to really low interest rates. Once interest rates weren't rock bottom anymore, then a lot of investors got stuck because they just bought anything and everything and expected it to always cash flow positively. So what you need to do is, when you're looking at buying a deal, make sure that you understand where the rate is on your mortgage in the current market and understand what it could be over the next few years. Obviously, we don't expect rates to go crazy, but if they do change slightly in 2 years' time or 5 years' time, the deal needs to stack up and still earn you a small profit every month. The final thing when you're looking at your numbers is looking at your return on capital employed. This is obviously linked with your rental profit, and how you calculate it is your rental profit divided by the total amount of cash you've put into the property, and it's expressed as a percentage. So for example, if you put in £70,000 and that includes your deposit, your stamp duty, your legal costs, your broker fees and everything else in between, you can work out your rental profit divided by that 70 grand. This allows you to actually see your return on your cash invested rather than just a yield comparing one property to another. Ultimately, things will change based on the rate on the mortgage, so again, you need to make sure that that's been stress tested moving forward, but this is an honest figure to what you're likely to get as a return on the total amount of cash that you've invested. Basically, it gives you the chance to make sure that it's worth you investing in that particular property, and you can compare your returns of having that money invested compared to something like putting that money away in a high interest savings account. There is obviously some limitations to return on capital employed because you obviously can't get that return based on capital growth. It's easier to look back in 5 years' time than to project forward because you don't know exactly the growth that you're going to get on the property, but it's a good indication of the immediate return you're going to get on your cash invested. And if you've already done the steps prior to this to make sure that you're investing in an area that's going to improve over time, then you can be confident on the long-term appreciation as well. So now we know the area is right, the property is priced correctly, and it stacks up from a cash flow perspective. We need to make sure that things are going to be the same in the next few years. This means that step 4 is the regulatory and the technical due diligence. Here we're looking for the silent killers you might not see immediately. This is ultimately a step that takes you from a beginner investor to someone who actually knows what they're looking for and knows what they're doing when it comes to due diligence and looking at deals. This includes things like looking at EPC rate changes that are coming in the next few years, making sure that the deals you're looking at will still make sense even with changes in legislation around the Renters' Rights Act, and basically making sure that the deal still works even with a slightly changing environment. This is very much important if you're looking at things like HMOs, when you can potentially be buying in an area with Article 4, but it's also important when you're looking at things like serviced accommodation, because if changes happen in the next few years where governments stop or very much limit serviced accommodation, the deal still needs to stack up from then a buy-to-let perspective if you need to flip the property back to a buy-to-let. Once you've looked at that, you can then start to think about things like leasehold. If you're buying an old leasehold property, you've got things like not just service charge, but also ground rent that could increase moving forward. And again, if you're looking at older properties, you need to make sure there's no cladding issues or there's an EWS1 form. This isn't as important when you're looking at newer quality homes, but you might be looking at some older properties as well as some newer properties as a way of diversifying. So it's something to make sure that you're aware of when you're doing all of this due diligence. Again, if you are looking at buying a HMO as a way to diversify, then make sure that you are looking at the local planning portals to make sure that Article 4 isn't a thing if you're converting the property. You should be able to find this online, but if you can't, make a few calls and make sure that you're confident on the outcome before you commit to a deal. This step doesn't take long, but it can be the make or break to an opportunity if you're looking at these certain deals. So you've done the first 4 steps and it all stacks up. The final thing you need to do before you commit to a deal is look at your exit strategy. Even if you plan on holding this property for 15 to 20 years, then you still need to make sure that you can exit if you need to at any point. Your situation might change in the next 5 to 10 years. You might need to get your money out of this property, and you need to make sure that you can do this in a relatively simple and straightforward way. Obviously, it does depend on the strategy that you're following, depending on what your exit might look like, but you need to make sure that you can exit if and when you need to. For example, if you're buying a buy refurb refinance project, your exit is ultimately the first refinance and then a long-term sell further down the line. The question you'll need to ask yourself is there comparable evidence of the higher value, and will I be able to get a refinance at the value I'm looking for, or is there a ceiling in the local area? And then you need to make sure that you'll be able to sell the property as and when you need to further down the line, because it's got the fundamentals that you're looking for. For a buy-to-let investor, it's actually pretty straightforward. Can I sell this property in the future to either a property investor or a home buyer? This is why buy-to-lets are often the easiest thing to invest in, because the exit is usually pretty straightforward. You're not limited like you are with student accommodation or HMOs, which can be difficult to exit in the future. And the main reason for that is the only people that are buying purpose-built student accommodation or HMOs are property investors. If the property market changes slightly, or suddenly that strategy becomes out of favour, are you stuck with a property and stuck with a property where you've got a lot of cash in it, where you're not getting the returns that you want? Or if you're just trying to exit altogether and put your money into something else, can you actually do this, or are you going to have to take a massive hit? This is why when I'm speaking to my clients at Frater Property Partners, we're making sure that they're aware of every single risk before they buy a property. Yes, HMOs and student accommodation have a part to play as part of a diverse portfolio, but you shouldn't just invest in those types of things. The easiest way to exit is just to sell to a home buyer that wants to live in the property that you own. You can't do that, and there's other strategies. So to conclude, that's essentially the Frater filter, a 5-step process you can follow every single time you see a deal, and you can actually get quite good at this to review deals in quite a short space of time. Step 1, where? What's the local economy looking like? Is there long-term fundamentals, and are you going to get the appreciation that you want and you're looking for? 2, how much is the property? Is it priced correctly? Are there comparable evidence, and are properties moving relatively quickly in that local area? 3, the maths. Does it cash flow properly, and does it cash flow even when you stress test against changing interest rates and things like that? 4, the rules. Look at the regulatory and the technical factors in and around the properties that you're purchasing, and make sure that you're not stuck when you're buying a property. And 5, exit. Make sure you can exit as and when you need to, even if you plan on holding this for a long time. Investors that build portfolios in the long term aren't better investors, they're just more prepared and they have better systems. Don't cut corners, and make sure you follow this simple process so you can be confident when you buy your next deal. If you are looking to invest in property and you don't have the time, or you're currently looking at deals and you're not sure what is right and what isn't, then I'll put a link to our website, Frater Property Partners, in the description, and you can have a free chat with one of the team. But that's everything for today, so I hope you've enjoyed the video, and I'll see you soon.